Question. Oh, this is very late. Yes, please. Yes, and if you wouldn't mind identifying your name and institution, that would be helpful to us.
My name is Hari Luitel. I'm originally from Nepal. I got my PhD degree. I graduated from West Virginia University, and in 2010, I moved to Canada. So this, I have a lot of story to tell, but to come to the discussion question here, I have a general question. My question is, I have a recent memory of 2007-2009 recession. We have not fully recovered. Countries all over the world, they are having problems. My question is, did we think through the problems? Public economics or political economy is my field, and one of the principles in political economy is when costs are spread around larger population and when benefits are concentrated, there is always possibility of time inconsistency of policy. In other words, since it creates a moral hazard problem. Okay. My question is, it also relates to my questions. When your research are confirmatory, it is easier to get published. When your research are not confirmatory, it contradicts, it is harder to get published. So my question is, did we think through? So that is my question.
I'm sorry, I didn't hear it.
So did we think through? Or that is my question.
Well, would anyone like to tackle this one? Well, could. Paul was actually president of the creation, so if anybody thought it through, I hope you did.
In the spirit of your question is one about political economy. My view is that the combination of the Financial Stability Board that comprises regulators, central bankers, and crucially for these purposes, finance ministers, and the G20, which is ultimately a meeting of leaders, has meant that the reform of the financial system has gone much further than it otherwise would have done, because particularly those leaders from democracies and the finance ministers from democracies, for finance ministers it's more potent in parliamentary systems, frankly, where they're elected rather than appointed as here. They go into their districts and their constituencies and they find people that are still very angry. And I think it has been as good a process I've seen of politicians driving for change without interfering too much in the technical detail. That's on the financial sphere. I mean, broadening it a bit for a second, if I may, I think the official sector community has done a much less good job at thinking about fault lines in the international monetary system. I think they spent too much time thinking about symmetric adjustment to persistent current account imbalances, which is, history shows, is pretty difficult to crack. But fortunately, I think a number of emerging market economies have innovated in order to make what I call their national balance sheets more resilient against contagion. And I think that's been a good thing. And I believe that the IMF will now be embracing that, and not only because I've advised them to do so.
That surely helped, though. Yes, did you have a quick follow-up?
I have a similar, minor comment, okay? Just like it is based on my experience. I do not have any specific, so my question is, did we think through? So this is my comment. Say in a university setting, we make decisions, and sometimes big people, the president, vice president, dean, they make decisions and they did not think through this. Oh, you didn't tell me, they tell us. So I'm telling my experience. Another experience is, it's like I'm from Nepal. Recently we celebrated big festival, and my parents are there. I wanted to send some money, say $3,000, and I wanted to transfer my money from my bank account to my father's account, and I wanted to pay it as high as say $45. My bank did not transfer the money, and what do I do? Just like maybe I need to find some informal channel. I work here formally, my parents are there, my minds are there, so what do I do? And this type of policies creates more informal, illegal activities. I do not know where to say.
I think what you're identifying is an unintended consequence of the anti-money laundering laws. And they have made institutions extremely averse to doing routine sorts of transfers that once would have been absolutely routine. And you know, I think there are always unintended consequences when you start pressing down on these things quickly. Yes, please. Thank you, Jalapa. This is Jalapa Jacktiani from the Philadelphia Fed.
Jalapa Jacktiani, Philadelphia Fed, yes. I have, my question is for Paul and James. Wonder if there has been any discussion around combining stress tests with resolution plan to ensure that the banks have sufficient capital and liquidity for the resolution?
So the quick answer is yes. There is thinking around the issue associated with looking at the recovery and resolution planning process as a continuum, not just a resolution planning process in isolation. So obviously, stress testing indicates what happens when an institution's capital is depleted and the institution runs into stress and enters into a recovery mode. As you know, there are work streams, both domestic and globally, that focus on this. I mean, specifically within the FSB. There are crisis management groups that look at this, and typically represented on a crisis management group will have a supervisor and a resolution authority. And that's where the two get to be, I'll call it, discussed. And I can say as a fact, when going to a level beyond that, when we were talking about writing the rules for resolution planning, we specifically considered how the U.S.-based stress testing fits in with that process. So even when, and this was back in 2011, at that point we were thinking about how the stress, and it's not just for asset but also liquidity testing, can be integrated into the resolution planning process.
I would add a broader point, if I may, which goes part of what I wanted to say in response to Mark, whose challenge to this, I think, is much more serious than the challenges of a number of other people, because it essentially, Mark's challenge is essentially, is it going to be credible that people will use these tools? Whereas often people say, will these tools work if they are used, which I think is a substantively different question. Where I think this relates to stress testing is that I believe that stress testing has the potential to bring about an absolute revolution in the political economy of prudential supervision and regulation. You, Mark, you talked about the success of monetary policy over the past quarter of a century, and I guess I spent half of my career doing that. I mean, the real breakthrough was through transparency. And it's not just that you're conveying the reaction function and you can be accountable to democratically elected people. It's both of which are vitally important. It is also that it absolutely transforms the public debate about what you're doing, and therefore it transforms what you do inside your building. I mean, it's the best possible management discipline. And nothing could have been more opaque than prudential supervision, far more opaque than securities regulation, which is entirely based on rules and then go along to the courts. Prudential supervision was completely opaque, including, I suspect, in many institutions from top management. Well, now, it's pretty transparent every year, and that means that if mid-year a supervisor or regulatory authority chooses to forbear, and not put a firm into resolution when objectively it should, it is either going to be caught out in 6 months' time or it is going to lie in 6 months' time. And so I think that the incentives are transformed, subject to the academic community, the broking community, the media, being as gripped by the annual stress test as they are by in this country, 6-weekly monetary policy decisions. I mean, in many respects, this annual stress test is more important than the average FOMC meeting.
Let me just make one quick comment. The thing that I like very much about the stress tests is it gets around the managerial optimism about what losses are going to be in the loan book.
Yeah.
It provides a standard. Now, there are all kinds of discussions about whether it's the right standard or the wrong standard, but it at least tries to get at the notion that somebody besides the manager should be predicting likely losses, and that has a first-order effect on capital.
All right, so before I headed up OCFI, I spent probably 15 years overseeing the resolution of depository institutions in the United States. During the course of that time, over 400 failed and over $600 billion worth of assets. I would say of the 400, well in excess of half, and I'm sure we could easily pull out the number, had the quarter prior positive capital. Yes, and some of them 9% capital or 10% capital on their books. Regulators are loath, and I mean that in the literal meaning of the word, to pull the plug on a regulated entity because it is an admission of failure. It basically means the supervisor regulator has not properly done their job, and it's a capitulation to that point. It is a very difficult exercise, and I myself, and I'm speaking just personally here, am highly skeptical that any one of these institutions will ever fail because of a capital inadequacy finding by a regulator. I don't remember observing that in the crisis of 2008 with a large institution. I rarely observed it in the failure of depository institutions. I have no evidence on the historic record to assume that there will be a change in that moving forward. What I do expect, though, is that when there is the prospect that one of these companies will not be able to perform a critical function in financial intermediation, the plug will be pulled. And what that will be will depend on the institution, the business model, and where it sits basically in its trajectory to a true capital insolvency. Because the market may force it. And this is what we observed certainly with respect to the asset repricing that occurred after the failure of Washington Mutual domestically, which failed. Washington Mutual failed because of a liquidity issue. It didn't fail because of a capital inadequacy issue. But immediately the market began to reprice the books of Wachovia because it had a similar mortgage book, identical, heavily invested in the West Coast because of its acquisitions as Washington Mutual. And that repricing then caused basically a short-term funding for Wachovia to basically disappear, and then it needed to basically be handled in some way. So that is, history, I think, is going to repeat itself again in this respect. But I'm not, I would say, as pessimistic as Mark is about when that's going to happen, because I never had any, I'll call it optimism, that the regulators would ever actually pull the plug because of a capital reason in any event. So to some extent, the accounting books, I think everybody recognized, do not match the true economics of the situation. And because of the, I'll call it, very difficulty and the legal issues. The legal issues are huge. I mean, if you think about the institution is going to fail at a time in which assets have uncertain values, and you're going to have a regulator making an argument against the management of the company, perhaps in a court, about whether or not the company is insolvent, you're going to get one expert that says yes and another that says no. And so, and that's inevitable. And so what what's going to be the triggering event basically is the prospect of the ability to perform some level of financial intermediation.
Well, I think you had it.
Just two things about the UK system, which varies slightly from the US in this respect. First of all, the resolution authority can petition the supervisor to put the institution into resolution, and that was because Mervyn and I didn't had your view of supervisors, and that wasn't a view about the people. We would have thought about it ourselves if we'd been the supervisors. And secondly, the criterion for going into resolution in the UK is that the criteria for being authorized are no longer met, and there is no reasonable prospect that they will be met. And that is framed in legislation where it would be quite difficult for a court to back the management unless it could be demonstrated that the official sector had acted unfairly, or in the language of UK administrative law, outside of the bounds of natural justice. I mean, there's lots of doctrine on that, so it couldn't be reckless. But I think if the test is balance sheet insolvent, which actually it isn't quite, then I mean that would be a very bad test. The EU-wide law, by the way, has absolutely replicated the UK arrangements for this for the reasons that I say.
Jim brought up the point that supervisors are often reluctant to initiate a resolution because it's an implicit admission of failure. That reminded me that we are, quote, celebrating the 40th anniversary of the introduction of the term too big to fail. It arose in the testimony of Todd Conover trying to explain why, despite the superb supervision Continental Illinois received, it nonetheless ended up as a failed bank. And at that point he added, gratuitously, most people thought, that 11 other U.S. banks were too big to fail. This was good news if you were safely in the 6 or 7, but because it wasn't clear how he was measuring 11, it created problems for the others. The other thing that I wanted to put on the table, and because it came up as Jim talked about the transmission of the shock from WAMU to Wachovia, is that we've really been talking about a system that at best might work for a single large, systemically important bank. But it is not improbable that we're going to have 2 or 3, or maybe even worse, more than that at one time. And I guess the question is this a system that could handle that kind of issue, or do we have to have yet another tool in the kit? But let me just sort of let that hang out there. Charlie? Oh, there it is. I'm sorry.
You want to ask a question?
Let's start with you first. Please identify yourself, and I'm sorry.
Yes, Gary Clayton, Northern Kentucky University. And I have the microphone, Charles. So.
Yes. The session is not quite so long.
Gentlemen, I want to thank you for a very fine panel. It was really rewarding to hear that today. Thank you for your time. My question, though, is a little bit different. It might be from the point of an economic historian. And it seems to me that the United States has had a relatively simple banking structure all the way from the beginnings in 1789 up through the 1800s and, into the 1950s. And I remember teaching money and banking in the 1980s, and it seemed like banking structure was fairly simple, and the insurance agencies we had was fairly simple. And then all of a sudden we turn around and we have this too big to fail that just sort of dropped on us, and this massive complexity that seems to be a surprise to everybody. So, if you were to play the role of economic historian, at what time did we hit that tipping point and become, or the financial industry become too big to fail?
Please. Nicole, do you want to comment on that, since technology is part of the question?
You want month and day or just the year? No, I mean I would place it somewhere in the 1980s. That's when you see the pickup of these new ways of doing financial intermediation asset securitization becomes a viable activity as a result of the passage of certain laws and also pure innovation, technology, really. And so if you observe the data, you do start seeing a pickup of build-up of complexity right around the mid-1980s, and then it goes on through the 1990s, and then of course the 2000s as well. So that was probably, in my opinion, one important turning point. And I had a slide in my presentation I couldn't really cover because of time pressure. This issue of the changing technology of intermediation was very clear in the mind of regulators back in the 1980s. I had two quotes. One was a quote from actually the president of the New York Fed in 1984. I wasn't there, but I found these documents where essentially he was saying, if this process of asset securitization continues, it will jeopardize the basic model of financial intermediation based on deposit taking, loan making, blah 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 blah. So that was happening right there, right at that point in time, and I think that's when you start observing the increasing complexity. And of course, I mean, the problem is more complicated than that because, again, there were existing restriction to the ability for banks to expand their organizational footprint. But as I was hinting in the presentation, that too was sort of an endogenous process that, piece by piece, Glass-Steagall kept being eroded until 1999 with Graham-Leach-Bliley. So I don't know if I answered your question, but
I could add a data point to that, which is some work I did back in the very early 1990s, and I was focusing on the regulatory aspect rather than the technology aspect, but it was fairly striking. I was trying to compare the legal structures of UBS, Deutsche Bank, and Citibank, which at the time had about the same market values. At the time, Citibank, and this was before securitization became a big deal at all, had several thousand subsidiaries. In fact, it was a dark secret. I was able to see them because one of my former students sent me the whole set of printouts because those were the old days, and then he called me the next day and said that I had to destroy them. But I did get to count the number, and it was astonishing. At that time, Deutsche had 90, and UBS, I think, had even fewer because both of them were universal banks and didn't have to indulge in these very bizarre organizational structures in order to do the range of things they wanted to do. Now, I might note that by the time we got to the mid-2000s, Deutsche was number 2 in terms of the total number, and there was no change in German regulation that would have required it to do so to get around any kind of inhibition on activity. So it's really quite puzzling what happened, but there were a lot of things going on. Paul?
Can I add two things, perhaps two and a half? I think the roots of a lot of what happened in the States is the inflation of the 1970s, which basically broke the model of commercial banking, or at least the model so long as there was a cap on the rate of interest that commercial banks could pay. I mean, that's what prompted the growth of money market mutual funds, the CP market, and a whole bunch of other things. So at that point, I think if you like, the underlying substructure of banking in this country was destabilized. And I don't think that made it inevitable that too big to fail firms would emerge, but it made it inevitable that the structure of the banking industry, as you describe it, was going to be transformed. The other thing I would say, if I may, is that, and this goes back to Dick's point about, well, what happens if a number of these things fail at the same time? And I'd like to broaden that a bit, which is both in this country, very much so during the 19th century and leading up to the creation of the Fed and since, but also in my own country, is that there were repeated crises of small and medium-sized banks failing. Country banks' failure in the early 19th century in England was an absolutely massive political event. The failure of Overend and Gurney in 1866, I think, maybe 1860-something anyway, was a trader, was a cataclysm and in our professional lifetimes, you had the savings and loans crisis. We had a small banks crisis in the early 90s, and in the mid-1970s. I think one of the great failures of Dodd-Frank is to assume that systemic is about individual firms that you could identify ex ante. I was brought up in the Bank of England to think that it was situations that were systemic. The point about these too big to fail firms is it's hard to think of a situation in which they wouldn't be systemic. But to answer your question, I think Mark Carney has said the same publicly as I'm going to say. Even if a bunch of them failed at the same time, which Charles Goodhart, for example, fails, well, then you won't use any of these tools. Bail-in doesn't work. I mean, that's not true, because even if, God help us, taxpayers' resources had to be used, there would be burden sharing. Mm-hmm. And burden sharing transforms the politics, even of a systemic crisis. And it also, and if people know there's going to be burden sharing, even in the worst kind of systemic crisis, you're still ex ante harnessing the energies and skills of people in BlackRock and PIMCO, etc., to analyze the banks. I find it hard to believe that in the next few decades that officials will, the way I used to put it in the UK is, so Barclays is failing and Mervyn King and I are in the car going to number 10 Downing Street to see the Prime Minister, and Mervyn says, just remind me what the plan is again. And I said, well, I'm not quite sure. Maybe it won't work after all. And he says, I think you'd better get out. And then he says, actually, I think we'd better get out. Because these are circumstances in which we've both had to resign. And the incentives on senior officials to try these resolution techniques, rather than to turn up and say to Congress or to the Prime Minister, give me loads of taxpayers' money, is absolutely, enormously in favor of using the tools that are available.
I certainly concur with what Paul said. I mean, I believe that even domestically, if we have multiple institutions failing at the same time, this approach certainly can work. But of course, there is a collateral to that, and that is it is not the only tool that will have to be used. It is a tool that will be used, and I am convinced it will be used because, to me, the politics, particularly domestically, it's untenable that this tool be granted and not be used. So it will be used, but there will be other tools as well, and I do think that some additional thought needs to be given and debate undertaken as to what the appropriate additional tools should be. When he sort of goes back to the comment about thinking through issues, I think that this approach is a very solid approach for the resolution of a single company, or even multiple companies, that addresses a lot of the very unpalatable aspects of the approaches that we had undertaken in the prior crisis. But to Paul's point, the savings and loan crisis domestically here in the late 80s, early 90s required a taxpayer bailout. These were small institutions, and yet taxpayers had to foot a $120 billion bill. So the size or complexity of institution doesn't necessarily remove the element of taxpayer or potential taxpayer support. But we do need to think through what tools should be available and what else should be implemented when one has a systemic issue that is being presented to multiple institutions, regardless of how, I don't like to say too big to fail, I just say too interconnected to fail, how interconnected a single institution may be.
Shall we? You now have possession of the microphone. Charles Calamari.
Thanks for a great panel, fellas. So I want to come back to a point that Mark made and that I think connects very much to Nicola's presentation, and stimulated also by Paul's comments about stress tests. So I want to talk about stress tests and get you to talk about one aspect. I agree with Paul that stress tests are a wonderfully promising, sort of forward-looking, scenario-based, and very powerful tool. But I also wonder whether they are sensible in their structure and are able to tell us much as they're currently being performed. And also, what worries me is what I think is a lack of connection between the information we need and some of the talent we need in the regulatory community to do the stress test properly and the current way it's being done. So let me be specific. Nicola points out that banks are not about old-fashioned balance sheets anymore. And Mark points out that market values often diverge from book values. And of course, those are connected because much of the cash flows that really determine bank values are unrelated to balance sheets. So we're stuck with this balance sheet fetishism that doesn't have to do with the economic value of banks. You wouldn't want to value most service firms based on their book values of equity, and these banks are now complex service firms. It's ridiculous to think that their cash flows are driven by their tangible assets and liabilities. In fact, right now, some of the largest banks in the U.S. have market-to-book values that are substantially less than 1, not because of hidden tangible losses, but because of cash flow problems relating to their intangible services. So what do we need? We need stress tests that actually are looking at these intermediation chains you're describing and modeling their cash flows properly. What does that mean? We need managerial accounting information to be integrated with financial accounting information by economists working at the New York Fed alongside the supervisors. But when I talk to people, so I'm putting you on the spot first, Nicola, when I talk to people in the Fed system, they basically tell me that, yes, the managerial accounting information exists. No, it's not being used. We're still stuck with balance sheet fetishism and these sort of half-baked stress tests. And the economists are kind of occasionally involved a little, but they're not really doing anything very centrally with those managerial accounts and the stress tests. So when are we going to get our act together and actually get people to do economically meaningful stress tests by using the managerial accounts and getting you and Anna and some of the other people involved deeply, not peripherally?
Well, I guess we know who that was targeted to. You have the right to duck, because you already displayed.
I will duck, especially because my boss is sitting there, so whatever I say may put me in trouble here. I think I don't really have a clever answer to your question. It's really. I would basically say that it is a work in progress, right? I mean, it doesn't have to be perfect from the beginning, and I think those considerations that you are raising are in fact well understood in the process, but it's a complicated problem.
We have a two-ended intervention from the organizer.
Yes, so
Nicola's boss,
First Vice President.
So I don't want to portray myself as an expert on the stress tests, but I do think, first of all, there has been tremendous amount of input and real hard work, model verification by economists, not just in the New York Fed, but around the system. Two, the Fed has published documents about what the nature of the stress tests are. There are elements of the stress test that involve estimating the revenues, which is not exactly the cash flows, but starts to come close. And so I just say, invite you, Charlie, certainly to come and visit us at the New York Fed and walk through a little bit of that process. But for the wider audience here, if this is a question in your mind, I do encourage you to go to the Federal Reserve's website and look for these documents, and we can find a way to get them posted to the IAS website, but also have some assurance. I think at the SCAP, which was the precursor, this was the test done in 2009, pivotal moment in trying to turn the tide on the crisis, and that involved at least 150 people, many of them economists. And the effort has only become larger, but also more automated, so therefore not necessarily growing a pace with people. But the amount of commitment that the Federal Reserve and the other agencies, I should add, but particularly in the Federal Reserve, the amount of effort that goes into these stress tests to this day is really significant. The biggest complaint we get is, from the banking community is they'd really like to see the individual models that we use for different parts of the stress test. And the challenge is, we all know the risk of the kind of engineering the results that come. But your point about values, sort of extreme values, what happens to valuation under extreme stress, that's a very interesting question. Not always sure that it's easy to model. The behavior is often one of panic that leads to those values. But again, so, point well taken, a good issue for us to look at in the stress test. But in terms of the level of commitment, the range of things that are looked at, and the effort to really get a picture of the value of the whole firm, rest assured, we're doing our best.
To be fair, I have been timing myself, and we're at the very margin, so I'd like to go around the panel for one last range of concluding comments, which can pick up on anything or make a whole new point.
Okay, well, let me follow up on Chris and Charlie. I was chairman of the Model Validation Committee for a while, 6 academics who looked over the development of the models, and it is very impressive how much progress they've made. To go to Charlie's specific point, the place where it's been difficult to make a lot of progress is in pre-provision net revenue. Now, think about what that means. That's before the provision for loan losses. It's a big number. Forecasting it over 9 quarters in a stress scenario is very difficult. Until 2 years ago, I think, those numbers came from the banks. And the past 2 years, there have been efforts to model those numbers. So I think they know how important the numbers are. I think they're having a lot of trouble thinking about how to model pre-provision net revenue. So for example, two quick examples. A crisis hits in commercial real estate. What do you do to the business mix in the bank? That's going to show up in pre-provision net revenue. Second, if capital falls at the bank, what's going to happen to funding costs? That also goes into pre-provision net revenue, and that's one of the things that Chris was saying is extremely difficult to anticipate, but they're working on it. They've been working on it very hard for a long time. So it's not to say that your point isn't well taken. I think it's been noticed.
So actually, my final comment relates to the stress testing. To me, the huge advantage of stress testing, of course, is reducing the probability of default by identifying areas of potential weakness at the firm, which the supervisors can react to, the institution can react to. But the reality is that the reason why an institution will fail is because the stress test didn't work. That neither what the institution anticipated nor what the regulators anticipated actually happened in real life. And now that might be the tail of the probability graph, it will be. But that's the reality of the situation. And when the question was posed earlier about the integration of stress testing and resolution, the nexus of those two, it really comes down to when that tail occurs and where you are on it, what will that do with respect to the potential for recapitalization through a resolution process that allows a viable firm to exit? And how much of a margin and cushion do you need? And of course, those are the discussions which the FSB currently undertaking right now, and obviously it's not one size fits all answer because depending on the business model of the firm, the activities it conducts, its footprint throughout the globe is going to really kind of drive that process and where the risk resides at the tail of the curve. Enough.
All I'd add to that in response to Charlie is I think the community is going to need as many conferences on this as typically take place on forecasting for monetary policy purposes. I mean, just the weight of all year round, all globe round intellectual effort on monetary policy must be 3 orders of magnitude bigger than maybe more than on this, and that gap has got to be closed. But the substantive point I'd like to make, because I don't think it's come up enough, and I want to underline it, is what we've been discussing can transform the regime for lender of last resort, which perhaps particularly in this country is in a bit of a crisis and needs reforming. But let me say something constructive about that. I was often asked in the Bank of England and since, but where's the funding going to come from for this? And I think it's absolutely the wrong question. And if the resolution techniques work, no one should ever need to use this Treasury line of credit, because the central bank should be prepared to lend as a lender of last resort if they are confident that the resolution is restoring the institution itself or some bridge bank group to solvency. And then that actually gives the central bank an opportunity to be on the front foot about we are solving problems with lender of last resort rather than doing dodgy things and sending up distress flares. And I emphasize that because I'd like the whole resolution reform thing to be used as a substantive way of changing the debate about lender of last resort, which I think is in a really bad place, but perhaps especially here in America.
Nicola.
Thanks. Yes, I just wanted to make a final point. I go back to my presentation before, but I realized that I have an opportunity to state whether I'm optimistic or pessimistic on things. And I think I am both. I am. It's a classic economist response. No, but there is a dark side to it. And I'm optimistic in the sense that actually, at the end of the day, I am afraid that the next crisis is not going to come originated from one of the entities that we have been discussing today. Exactly because I think there have been massive improvements both on the oversight, the regulatory side as well, stress testing, and what have you. Again, the problem, to go back to my presentation, is that it doesn't take much to be an intermediary nowadays, and so the focus is not just on the SIBs, the one that we prudentially regulate. The focus is actually on the other entities that right now are not subject to any stress test. They are not subject to any prudential regulation. They are not in any way, form or fashion, within the scope of any provision of lender of last resort access, and so forth and so on. The only line of defense that I can see right there, right now in the United States from Dodd-Frank, is the possibility to designate these entities. On the global arena is the similar process of the G-SIFI that we were discussing before, and which I actually know something about it because I've had the fortune to represent the New York Fed on the Financial Stability Board working group that is designing or attempting to design the methodology to designate global non-bank, non-insurance companies systemically important financial institution. And so I think that there has to be also a lot of attention devoted to that aspect of the problem.
Well, you may think that what we discussed this afternoon was sufficiently complicated, but Nicola has reminded us that the real world is still more troublesome, but that's going to have to be the subject for another conference at another time. Please join me in thanking Mark, Jim, Paul, and Nicola for a stimulating conversation. And also thank the organizers, Christine and Joe, for having put all this together.